Okay, let's dive into this explainer and demystify the famously complex US tax system. Look, if tax season gives you that familiar creeping dread, or if navigating your returns feels like wandering through a labyrinth completely blindfolded, you are absolutely not alone. Today, we're going to break it all down by looking at the specific experts who can guide you, the massive digital grids they use to keep you compliant, and finally, why the United States is such a wild global outlier when it comes to its tax structure. Our roadmap today takes us on a pretty fascinating micro to macro journey. We'll start with the specific people who prepare your taxes, move up to the IRS's underlying digital infrastructure, and then zoom all the way out to see how the US structurally stacks up against the rest of the world. So, Section 1, choosing your tax expert. First up, let's figure out who actually holds the map to this maze. In the tax world, the absolute most critical concept to grasp is something called unlimited practice rights. This basically means a practitioner has the ultimate legal authority to represent you in any matter, before any IRS office, no matter how messy it gets. There are three main categories of practitioners who hold this golden ticket: certified public accountants, enrolled agents, and tax attorneys. Now, you'll definitely also see support staff in the mix. They're fantastic for prepping standard returns and running financial models, but they're always going to have to escalate the truly novel, contested issues up the chain to one of those top three fully qualified pros. But how do you actually utilize these experts? Well, think of a CPA as your general contractor. They're state licensed, they have a very broad scope, and they are your absolute go-to for standard compliance and general wealth planning. But on the flip side, we have the enrolled agent, or EA. These folks are credentialed directly by the IRS itself, either by passing a grueling 3-part exam or logging 5 years of actual IRS experience. They are your true IRS whisperers. If you're facing a scary collection matter or you just need serious audit defense, an EA often provides the best value. They have the exact same legal authority as a CPA to represent you before the IRS, but typically at a lower cost because of that highly specialized focus. But what if you're facing something truly high stakes, like potential litigation or a complex criminal tax defense? That is exactly when you need a tax attorney, because they provide the one absolute thing CPAs and EAs cannot offer: attorney-client privilege. It's basically an impenetrable vault for your most confidential advice. However, thanks to a really fascinating legal workaround called the Koval Doctrine, a CPA or EA can actually work under that attorney's umbrella of privilege. But, and this is a massive but, this structure has to be carefully established before any of the work actually begins, or you could completely blow your legal protection. All right, Section 2, the IRS Digital Grid. We know who our guides are, so let's check out the digital terrain they actually have to navigate. The absolute cornerstone of this terrain is the EFTPS, the Electronic Federal Tax Payment System. It's the mandatory electronic deposit system used across the country. Whether you're a small business owner running payroll for the very first time or a massive corporation making quarterly estimated payments, you are inevitably going to collide with this system. The crucial reality here is that paper checks are completely dead for these kinds of federal deposits. They're just not accepted, period. But here is the major trap that catches so many taxpayers off guard. First-time enrollment in the EFTPS takes 5 to 7 full business days. Why? Because the IRS literally has to mail you a physical PIN for security. So you absolutely cannot wait until the day a payment deadline hits to enroll. Otherwise, you're looking at immediate and entirely avoidable penalties. And this just builds out the rest of the IRS's massive interconnected digital grid. They've constructed this sprawling net with one ultimate goal: pull everyone away from paper. Beyond EFTPS, they mandate the use of IRS e-file for any tax preparer doing more than 10 returns a year. For complex business returns, they rely on the modernized e-file system to get near instantaneous receipt of huge corporate filings. And for individuals who just need to pay a quick bill, they offer IRS Direct Pay. The whole thing is designed to be a highly trackable, inescapable digital ecosystem. Moving on to Section 3, how the U.S. stands alone. We've looked at the experts and the digital tools, but why is this entire U.S. tax ecosystem actually a massive structural anomaly on the global stage? Neutrally speaking, the U.S. tax system is built on a very rare foundation: citizenship-based taxation. Almost every other country on Earth uses a residence-based model, meaning you only pay taxes where you actually live. But the U.S. expects its cut no matter where you are, taxing its citizens and permanent residents on their worldwide income. To put that into perspective, aside from the U.S., only the country of Eritrea uses this model. That means a U.S. citizen who has been living, working, and paying local taxes in London for 20 years still has to file a U.S. tax return every single year. As you can imagine, this global reach leads to some massive compliance stakes. Because the US wants to know about your worldwide assets, we have sweeping rules like FATCA. Have a foreign bank account, you have to file an FBR form to disclose it. And the penalty for willful non-filing is an absolute jaw-dropper. It's the greater of $100,000 or 50% of your total foreign account balance per year. Let that sink in. And even if it's an accidental, completely non-willful mistake, you're still looking at a $10,000 annual penalty.
And this perfectly illustrates another massive structural headache, the total absence of a federal consumption tax. Most developed nations, the EU, the UK, Australia, they fund their governments partially through a single, unified national value-added tax, usually hovering somewhere between 5 and 25%. The US, zero federal VAT. Instead, businesses have to hack their way through 45 entirely different, distinct state tax systems. Retailers have to meticulously track their economic footprint in dozens of different jurisdictions just to stay compliant. It's an administrative nightmare.
Now, when it comes to corporate profits, things are pretty interesting. The US used to have a complex graduated rate system that went all the way up to 35%. But post-2017, they shifted to a flat 21% federal rate for C corporations. It was a highly strategic move designed to place the US just a hair below the OECD global average of around 23%, making it super competitive for corporate structuring. However, the global landscape is constantly shifting. Enter the OECD's Pillar 2 initiative. It's essentially a global game of cat and mouse to stop multinational profit shifting. They're actively trying to establish a global floor, a minimum tax of 15% on corporate profits in every single jurisdiction worldwide. The whole goal is to kill the incentive for massive companies to constantly shift their income through low-tax jurisdictions, like Ireland, which famously sits at 12.5%.
But returning to the individual taxpayer for a second, the filing experience itself is completely different in the US compared to its global peers. In a lot of Nordic and developed countries, the government literally just does the math for you. They use exact withholding and send you a bill or a refund. No annual return required for most regular employees. But in the US, the burden is entirely on you. We rely heavily on complex self-filing, meaning you get to spend hours painfully crunching your own numbers, tracking your own deductions, and submitting a highly detailed annual return.
To cap off just how unique the US is, you really have to look inside its own borders. It's essentially 50 different tax jurisdictions battling it out. In most countries, you have a unified national tax system with very little local variation. But in the US, individual state policies swing wildly. You literally have 9 states with 0% state income tax, while others soar up to 13.3%. It creates this massive internal tax competition, adding yet another thick layer of complexity to the maze. So we've seen how the US system is this totally unique global outlier, from taxing based on citizenship to relying on 45 different state sales taxes instead of a unified national VAT. It's a system built on mandatory digital grids and enforced by genuinely intense penalties. Which brings us to the most important takeaway of this explainer, and a question I'll leave you to ponder. Given the staggering penalties, those sprawling digital requirements, and the sheer global uniqueness of this system, when it's your turn to step into the labyrinth, who are you going to trust to hold your map?